Part 2 of Capital Assist Pricing Model. The entire formula considers the returns which an investor is liable to receive due to their risk-taking ability and extended time of investment. The beta factor is determined as a risk in conjunction with current market conditions. Therefore, if the risk associated with an investment is lower than the present conditions, the beta value will be less for the risk equally that of market conditions. A beta of the equation will always be equal to 1. Lastly, if the risk exceeds that of the established market norm, beta value in the formula will be greater than 1. Advantages of CAPM. Assumption of a diversified portfolio. This model assumed that an investor maintains a diversified investment portfolio which can eliminate specific or unsystematic risks. Convenient and simple. This is built around the fact that it is extremely easy to use. The results from such calculations are dependable and enable investors to decide one way or another when it comes to charging particular equities. Systematic risks can alter this calculation significantly. Drawbacks of CAPM. Risk-free rates tend to change frequently. Risk-free rate is not a realistic factor. Determining the beta is challenging. Example: for a simple example calculation of the cost of equity using CAPM, use the assumption listed below. Risk-free rate RF is equal to 3%, beta is equal to 0.8%, RM is equal to 10%. The return of investment is, therefore, RI is equal to RF plus beta into RM minus RF, which is equal to 3% plus 0.8, open the bracket, 10% minus 3%, close the bracket. RI is equal to 8.6%. Hence, the CAPM is based on the assumption that all investors have identical time horizon. The core of this assumption is that the investors buy all the assets in their portfolios at one point of time and sell them at some undefined but common point in future. The CAPM is a widely used return model that is easily calculated and stress tested. But still it is criticized for its unrealistic assumptions. Despite these criticisms, the CAPM provides more useful outcome than either the DDM or the WACC models in many situations. The model provides a methodology for quantifying risk and translating that risk into estimates of unexpected returns on equity. A principal advantage of CAPM is the objective nature of estimated costs of equity that the model can yield. Since CAPM describes the relationship between systematic risks and unexpected returns for assets, particularly stocks, CAPM is widely used through finance for pricing risk securities and generating expected returns for the assets given the risk of those assets and cost of capital.